Good morning in Europe. Welcome to the Probus Pleion Spotlight on Global Credit. I am Mark Stoudenman, partner at Probus Pleion, and it's a privilege to be your host today. Thank you, dear audience, for joining us. When I look at my personal investments, I'm wondering, how significant is my dependency on credit? Are we in a credit bubble? Which segments of lending are safe? And where are the true risks? Or are there actual opportunities that I'm missing? What are your questions when it comes to credit? Can I encourage you to use the chat function for your questions from the very start? This will help us to organize and answer your questions in a more complete way. Thank you. We're delighted to have an exceptional speaker for you today, and it's with great pleasure that we present Henry Craik-White of Schroders Capital. For over 2 decades, Henry has managed investments in the credit market with a particular focus on Europe. He is a key representative of the very strong team Schroders has engaged, and it's a privilege to have him with us today. Let me also use this introduction to highlight our next webinar to you already. We hope to welcome you again on Tuesday, December 16th, at this time of the day, when we will share the Probus Pleion Outlook 2026 with you. Besides the global outlook presented by Chief Investment Officer Adrian Kirigin, we will have a deep dive on AI. For those of you who remember, we had Bank Vontobel in our initial Spotlight On some 5 years ago, where they discussed the topic of AI in detail. Back then, of course, we were quite positive. Today, with growing concerns, and thus feel it is time to listen to the same team again. Finally, we're going to discuss a strategy that made 10% return on average over the past 5 years. This with very little volatility and almost no correlation. We will therefore debate the important points of consideration when one contemplates investments in music royalties. Overall, this will be a somewhat longer session, but we'll keep it under 100 minutes. Please schedule your time accordingly. We will be sending the invitation next week. Now, before I start, I need to cover a few technical points. Please bear with me. We'll discuss global credit together with Schroders Capital. We'll dig deep into the investment segment and look at risks and opportunities. We'll review where the market currently is and consider where it could go in the future. We'll also learn about some of the abilities and ideas of Schroders Capital. However, in order to remain compliant, we'll not be able to share securities advice during this call. Our content is not to be seen as investment advice to you. We do not give investment recommendations to a broad audience. Our presenter will show his own view, opinion, and strategy. My colleagues and I will be happy to assist and answer your personal questions and recommend a strategy and investments that fit your personal situation during a bilateral discussion. We want to make sure that our recommendations are meeting your expectations and are within your risk tolerance and help you to achieve your goals and ambitions. Besides this, we'll assure compliance with both our regulations in Switzerland as well as your local rules. With this, let me hand over to Henry Craik-White, Lead Portfolio Manager at Schroders Capital. Henry, the floor is yours.
Great. Thank you, Mark, for the kind words and your introduction. I'm very pleased to be here this morning from Zurich, talking to all those who've given us their time to dial in. I'll put the slide deck up in 2 minutes or in a minute, but yeah, today our focus is on a little bit of background on where the credit markets are right now, but quite quickly we will pivot into the leveraged finance markets within Europe in particular. There is some change going on that we would like to talk about and explain why that's happening, and using our crystal ball to look a little bit further into the future to hopefully give you an idea of where we think these markets in particular are heading, and to hopefully make you more informed when you leave this webinar than when you first joined us. So without further ado, let me share the presentation. Hold on, I just need to request. Mark, you just give me permission to share if that's okay.
Yes, absolutely. Mark. Has it worked already?
Yeah, that's live. 1 second. Here it comes. Just confirm, Mark, you can see that.
Yes, I can. Thank you.
Perfect. Okay. So a little bit about me, Mark, give you a quick bio, but there's a full sort of CV on the left of my career. I'm actually a scientist by training, but pivoted to the financial markets at the start of my career, where I joined the Royal Bank of Scotland in London as a associate director in their mid-market leveraged finance team, originating, underwriting, leveraged buyouts with private equity firms focused on UK and European mid-markets, before moving to the buy side and joining Blue Mountain Capital in London, which is a long-short credit hedge fund throughout the financial crisis. And then again, pivoting to more of a research role for a few years as head of sub-investment grade research at European Credit Management, which ultimately was bought by Wells Fargo. And from 2016 until I left there in 2022, I managed the high yield and loan strategies on that platform, and joining Schroders in 2022 to set up a loans business here at Schroders. So just a little bit about the piece of Schroders that I come from. So I'm part of Schroders Leveraged Finance Unit. We are a team that has strong DNA about what we do and how we do it. We are an alpha-focused team within the credit markets, where we look to extract alpha from all parts of the market, where we see inefficiencies, and delivering that to our investors in terms of higher total returns relative to competition and relative to benchmarks. To do that, we are very much a bottom-up house in terms of looking at single assets and single asset research. And to make that work, we have a highly integrated portfolio manager research team, sits all together in London, allows us to discuss and confirm or deny theses around potential investments in real time, based on data and news flow as it comes through, making sure that we are agile and fully well informed in terms of what's going on in the market to make those decisions. We also work on the basis of having very strong forward-looking views, not just on single assets, but on markets per se, in terms of drivers around the credit cycle, for example, from a top-down perspective that feeds some of the bottom up in terms of when we get into that single asset selection. We do need to at least have a high level thoughts around some of the big stories and levers in the market that could change the direction of some parts of a single assets business model, for example. That performance comes out in our funds, and our key funds are listed here. Top half being the leveraged finance part of the business, and the bottom half being investment grade credit. As you can see, sort of the medium, short, long-term characteristics and return profiles for these strategies is very strong, with lots of first decile performance across different time periods, making us one of the most successful performance-driven platforms within the European credit market. Here's a high-level view of the team of portfolio managers and those that support us. So the top 6 boxes are those involved in the day-to-day, those faces day-to-day management of different strategies, with particular area focus listed underneath. We cover the full breadth of leveraged finance market, from direct lending on one side of the return and liquidity space, all the way through to short duration crossover high yield run by Peter Harvey on the right hand side, if you like, of the spectrum, and other strategies in between, including high yield opportunities and European benchmark high yield run by Hugo Squire. And as I say, we are supported by, at the bottom, our three investment directors who keep our interactions with sort of clients and product related matters organized such that we're left to our day-to-day business of investing and generating that alpha for our end clients. And as I say, an important part of our picture is the second box down on this slide, which is the large research team. Again, we are supported by the largest credit research team for a European credit desk, all based in London. And that again enables us to have strong depth and conviction in terms of what we're doing. And these individuals create area of expertise in terms of the sectors that they cover, giving us full coverage in terms of understanding of what's going on in each individual market at any one moment in time, and able to bring cross-read from one issue to another, again, to keep us fully informed as a portfolio management group of any change in thematics that are rolling through different parts of the market from a fundamental perspective. So that's us. That's where I sit within Schroders, and what keeps me occupied on a day-to-day basis. But let's just take a step back and have a look and a quick think around credit markets in 2025. 2025 going to 2026. I think the opening line to this slide, interesting times, is perhaps an understatement. There are some quite large tectonic plates moving underneath us right now, we feel, in terms of the way businesses are set up, the way they operate, the way the macro in different parts of the world is moving in terms of cycles. US versus Europe is obviously something that we spend a bit of time thinking about. The K-shaped economy in the United States, for example, with huge capex being spent on AI, whilst the Main Street seems to be struggling a little bit, relative to what we're seeing in terms of some of the larger corporates. And then, again, behind this, we have the sovereign question mark around how long can deficits be run. The US is teeing itself up for large fiscal expansion again next year, but then potential tightening beyond that. France probably needs some fiscal tightening. The UK is sort of treading a very narrow line and is trying to pretend that it is doing fiscal tightening, but big question mark whether that's actually going to happen. Again, we'll find out next week. Closer to my part of the world, we had the volatility that came through from the First Brands situation in the United States. Again, I'm happy to talk about that in a bit more detail later on. But is that a canary in the coal mine, or is it a one-off idiosyncratic event? As I say, we'll touch on that as well. So yeah, lots of interesting topics floating around the world, floating around the capital markets and global markets. And from an investor perspective, taking all this in, I think, can be somewhat difficult. And for us, whilst these aspects are interesting and key in terms of what we do and how we do it, there is still a fair amount of noise here relative to the underlying fundamental picture, which actually for most markets has remained pretty strong. So if I think from a credit perspective, credit defaults are still very low. We haven't seen any material pickup in what we've seen recently. The concerns around some of the capex spend on AI in the States, clearly it's the large tech companies that are spending this money, and the majority of these companies have large cash balances and free cash flow generation that largely supports a chunk of this spend, which again is a little bit different to previous large capex cycles we've seen that have tipped over companies that have been free cash flow negative and money has been lent on the assumption that growth will delever those balance sheets. So arguably some of that spend is a little bit more defensive than what we've seen in past large capex cycles. And then, your main sectors globally have behaved pretty well. So if we think about fundamentals, as I say, default rates remain, well anchored across the board. Corporate balance sheets, again, have positioned themselves and been in pretty good conditions. But as a result of that, and we sort of pivot here to the credit markets per se, and think about valuations, that has that confidence, if you like, and the wish to capture yield has driven valuations to a point where public credit looks, quite expensive. If we look at the last 10-year percentiles, especially if we look at it on the left-hand side versus sovereign, which is the blue bars everywhere, we can see that everything from IG to high yield to EM looks quite expensive, and I think it probably is quite expensive relative to, as I say, where we've been in history, and parts of the market where we look to try and uncover value, we have to get into in our view, sort of the loan parts of the market in particular. So on the right-hand side of that left-hand chart, you can see that the spread percentile for the European syndicated loan market is at the 53rd percentile, so significantly cheaper than what we're seeing in fully public credit. The equivalent in the US is the 33rd percentile. So again, offering some relative value and some respite versus tight spreads that you see relative to sister asset classes, namely high yield, for example. Drilling into that a little bit on the right hand side, again, and this is on an asset swap basis, which is why your IG investment grade suddenly looks better value, but again, versus govies, the numbers are somewhat tighter. But if we look again across the board of the different rating buckets of high yield and looking into the loan space, high yield, as say, looks relatively expensive, except the weaker parts of the market. And that is true in the loan space as well. But what's different in the loan space is there's more value in the single B segment, and a lot more value in the double B segment. And this starts when we start to break down markets and segments and what's actually going on. Why is the safest part of the European loan market trading relatively cheap compared to anything else in the double B rated space? And this is linked to a strong overweight in that part of the market to the chemical space within the European economy, which actually is a bit of a tough space right now. But it has created quite a large value opportunity potentially for investors who can look through different parts of the cycle, deploy capital at the point where yields are very wide and high, and ride that out to enjoy the spread compression that would probably likely to come at some point in the future. So this takes me to what we think is a really interesting part of the European credit space right now, and a space that is probably changing faster than anything else that we're seeing. And this is the topic of public and private credit convergence, which is something I'm sure you've all heard and read about in the press. There are various private asset managers talking about this. We've been talking about it for a while as we've been seeing what's going on. And this is essentially the concept of corporate finance being provided on the basis of agnosticity around instrument that's used to finance those corporates. And I'm going to focus here on the leverage parts of the market, so the buyout space, as our example of where we see public and private credit converging, such as the difference now between a direct lending instrument relative to a syndicated loan instrument, so compared to a secured high yield bond instrument. All those three markets are becoming more and more similar, and the use case for those three instruments is becoming more and more similar. And we'll look at that and understand why that's happened and what that really means. We'll then take that to the next stage, and we'll make the case around the fact that those three instruments have started to look and feel somewhat similar has created some structural inefficiencies within the market that I think investors who have been in one of those silos in the past need to think about and reassess how they allocate across this part of the market in the future to make the most of those inefficiencies and position themselves for ways to capture alpha from this market on a look forward basis, which really comes down to our final point, around the fact that you will be able to enjoy high yields from investments in the space. You will have access to high levels of income, but for the first time, this market offers the potential, assuming that a manager is operating on the basis of and has a track record of alpha creation, of actually pulling alpha out from the space as well, which again we think is a new development and again exciting for potential investors who buy into this thematic and the new wave of funds that is coming to the market. So, without further ado, let's get into this part of the market. So, for those who aren't as familiar, the direct lending space globally has been in fairly rapid growth really since the financial crisis of 2008, 2009. And we've seen pretty rapid growth across the board, such as the private debt space is forecast to be pushing towards $2 trillion in terms of market size by the end of 2026. And within that, the direct lending part of the market, which really focuses on finance available for corporates to grow, to buy other companies, or for private equity firms to acquire companies, makes up the majority of that, has sort of pushing and is pushing towards $1 trillion market. Within this, if we repivot towards Europe, we can see that the creation of this market essentially came about really from the left-hand side, from the withdrawal of commercial banks from lending into the sub-investment grade space in Europe. So we've effectively seen €1 trillion of capital come off bank balance sheets, and that funding gap has been made and filled from really two parts of the market, from the public side of the market and the sort of crossover part of the market in terms of high yield and syndicated loans have made up a reasonable chunk of that for corporates to fund themselves. But the new space, which obviously has shown the most growth, has been the private debt space on the far right-hand side, which has really gone from a standing start of near zero, as I say, around the time of the financial crisis, to nearly a 300 billion euro market in Europe. And this is how companies see themselves. So the quote here from UBS: say companies can effectively engage with all three asset classes, bonds, loans, and private loans, to achieve the best cost of capital and align with investor preferences. So borrowers are already, and have been for a while, looking across these three funding options of secured high yield bonds, secured syndicated loans, and a direct loan, and choosing which instrument works best for them in terms of that finance option. We'll touch on this a little bit later on, but just to introduce the concept, as investors, we've been very poor at allowing ourselves to pick the best risk-adjusted opportunity at any one moment in time within this space, because as investors, we have been siloing ourselves either into high yield investments in one arm, syndicated loans on another arm, and a direct lending sleeve on the third arm, rather than looking across these instruments as a credit continuum. So in essence, we've been giving companies a advantage in terms of how they are arbitraging capital market use, but as I say, as investors, we have not, and I'll talk a bit about that later on. So to understand the mix of private debt and in particular how direct lending has grown, again, we can see here the dark blue part has been taking an increasing share of the private debt space over time, and now does make up the majority of private debt is the direct lending part of the market, which again is sort of the focus piece here, and how this has converged, as we say, with the syndicated market and secured high yield bonds as well in terms of use, price, and terms. So that leads us today, if we look at the mix between the three, in terms of funding instruments, we can see sort of how the development has changed over time. So the far left-hand side, and all the way back to 2002, what there was in terms of capital markets in Europe was actually quite small, but the mix was very much bond heavy, with most loans still remaining on bank balance sheets, which is where I started my career. We didn't, sell loans to third-party investors. We used bank capital. We were sole lenders, so effectively a direct lending operation in all but name, other than, as I say, the capital was bank balance sheet capital. And then that all changed, as I say, in 2008, 2009, as the cost of having sub-investment grade capital on a bank balance sheet became exorbitant following the Basel III rules, such that banks then started to withdraw from the market and look at ways to help originate capital for corporates, but then fully distribute that capital once that deal is done. So move towards the US model. And at this point, we then see the growth in the private credit universe and direct lending in particular start to increase. Senior loans started to hold market share and actually grown market share in the last couple of years, and high yield has been reducing in size as a relative instrument for financing private equity buyouts, but still remains a major piece of the market, but not as large as it once was. And so if we start to think about those users of capital, and as I said, the focus really in terms of those who use buyout capital in particular, but loans and bonds that are rated single B across the markets that we have 100% look through for. So this is for the syndicated loan market and for the high yield bond markets. 81% of those companies are owned by private equity firms. And private equity firms are sophisticated investors, and they have already positioned themselves to, if you like, arbitrage the different options of capital, debt capital that's available to them. So the majority of Europe's private equity firms have capital markets desks, and those capital markets desks will look at ways of funding their acquisitions in the most efficient way possible. So they will run a option for a pure direct lending solution. They will look at a syndicated loan solution. They will look at a pure high yield bond solution. And they will look at a combination of all three of those to achieve, from their perspective, the best cost of capital at the best terms in which they think suits the buyout that they're trying to execute. So the users of this capital already see those three markets as a credit continuum, and they are sophisticated in terms of the use of that, and they arbitrage that market to get best outcome for themselves. And so now is the moment that we think investors need to think about that in the same way, that credit continuum being one universe of investment opportunity that is moving under our feet on a daily, weekly, monthly basis, and allocating capital where deals come up that are particularly attractive relative from one sector to another, irrespective of whether it's a direct loan, a high yield bond, or a syndicated loan. And this is where we think the market is currently structurally inefficient. So what has happened? We have all been living in silos, which is at the bottom right, direct lending, syndicated loans, and high yield. And that in itself has created these inefficiencies within the market because of the siloed effect. A lot of investors have a private side allocation team that only looks at the private direct lending. Syndicated loans tends to sit more on the public side in terms of public credit, in terms of how investors allocate to that alongside high yield. So there is very few investors that we found that are set up to actually think about and look across all three silos at any one moment in time and think about how do we extract the best value from this market. The issue with this is that capital raised in particular from the direct lending market over the last couple of years, in our view, has been based upon past performance, which has been good, low volatility, nice returns. But we think the market has changed partly because, and I'll talk about this in the next slide, the success of those markets has meant that a large amount of capital has been raised, but is now being deployed into fewer and fewer attractive situations, such that we are seeing, and we're starting to see signs of perhaps a misallocation of capital from 2021 to where we are today, as that capital is arguably chasing deals that perhaps it shouldn't be chasing. And we're seeing that come out in terms of some elevated stress within those markets. Both, we see that from recent headlines, particularly First Brands being a good example. We're seeing that in terms of price compression in that market, and we're seeing that in terms of terms in terms of the underwriting terms and documentation terms around the lend into that space. And that, in essence, creates the inefficiency around pricing because, particularly in the private space, just a standard beta allocation to direct lending for us no longer cuts the mustard, as it were. We think that investors are not being paid for the illiquidity in the way that they used to be. And most investors from a direct side, as you say, are illiquid and locked in. And so the ability to then reallocate into more interesting opportunities as and when they arrive across those three verticals of direct lending, syndicated loans, and high yield bonds is simply not there for them because there isn't a fund structure in place that allows that to happen. And I think at this point, I would also say that had investors had the option to run private credit direct lending with syndicated loans and high yield bonds, under the same fund structures, then something like First Brand simply would not have happened. And the reason being is that the private credit solutions were all on the off balance sheet side of First Brands. And that deal flow has been shown to private credit lenders there, where they were looking at making returns of 15, 16% for what they perceived was only 40-day risk in terms of invoice financing and inventory financing as well. Whereas on the on-balance sheet side, and whilst the lenders were in the syndicated space, they didn't and weren't being shown the deals that were going on the off-balance sheet side and vice versa. So if you had an investor who was looking across both and would have been shown deal flow from both the private credit side and the syndicated side, the investors would have quite quickly figured out that you cannot live with a situation where you are highly levered on the off-balance sheet side and highly levered on the on-balance sheet side, such that the business was extremely high risk in terms of the level of leverage that it was running. And these deals simply would have been happened. That financial structure would never have been created. So, one can argue from a safety perspective as well, that if we move to a position of looking at all three markets as one credit continuum at one moment in time and assessing all deal flow across all three verticals, then again, the governance side of the market we think is likely to improve. We can avoid things like First Brands in the future too. So coming back to, again, the dynamics around shifting sands and the fact that there is now fluidity within the market in terms of these three verticals. We can look at, for example, on the left-hand side here, the movement of direct lending loans being refinanced by syndicated loans. And this is actually for the US markets, where the data set is quite rich and well informed. And this is now happening at the fastest pace we've seen since for the last 5 years anyway, that direct lending deals are being refinanced very quickly, and direct lenders who have raised a reasonable amount of capital based on past performance are now seeing the assets that they have underwritten, that they enjoyed lending to because they had a good lending experience, move into the syndicated space, and they're not able to follow those deals in terms of capital deployment, leaving them a smaller and smaller pool to deploy capital at the point where they have more and more capital to deploy. And that creates, again, this pricing inefficiency in the market, where lenders on the direct side, in terms of sort of generic direct lending, are forced to compete both on terms and on pricing with the syndicated market. And if we turn to Europe on the right-hand side, that is coming out most obviously in pricing. And we can see so far in 2025, there's been meaningful compression between the spreads that one can earn from a generic direct lending fund to those that is on offer in the syndicated loan market. And that differential is now down to not much more than 50 basis points. And as an investor, you would have to decide, is that 50 basis points compensating me enough for the illiquidity that I am essentially subject to on the direct side, but also the fact that the terms on offer from a direct loan in terms of documentation protection for that loan actually look more and more like the syndicated market on a daily basis. But I'm in an instrument that I can't trade. And therefore, if something does change within that underlying lend, that manager is ultimately stuck in that situation. and has to work that out at a price, again, of which is locked from the day of origination from where we are today. We see that as a position in the market that arguably is going to create a return profile that is not as attractive as one that was in place in the past and that investors have benefited from, such that our argument starts to fall into place around nimbleness between these asset classes in terms of where you deploy and when you deploy really, really matters. And if you start to look at deal flow on a single asset basis in terms of week in, week out, picking the best deals that are on offer across all three verticals, you start to mitigate these issues around misallocation of capital and then the ability to capture alpha as you move through the credit cycle. Turning to how we think the private direct lending side is likely to evolve, and this is an important piece of the pie because in the US we've seen a really strong precedent, we think, for what was likely to happen in Europe, and this has been in terms of the growth that we've seen within direct lending in the US, but the vehicles in which investors have funded that growth, and the majority of that growth is coming from two types of instrument. One has been private CLOs, collateralized loan obligations, which is the green bar chart on the left-hand side, to see very rapid growth. And then the second vehicle that has seen a lot of growth is BDCs, so business development companies, and in particular private BDCs, again, where investors can buy shares in these companies and have access to direct lending loans. And again, this has seen material growth. These vehicles work on the basis of having good access and diversification to a large number of loans. And as the markets have grown up in the US, what we've seen, in order for investors to have that diversification in funds, we've actually seen less and less single lender-led deals on the private side and moving more towards a clubbed market where multiple investors have access to deal flow within the marketplace. And we tend to see deals that actually look something like what we had in the syndicated space in Europe 10 years ago, where deals were done really with sort of 10 to 15 lenders to get it done. And that has all started with the larger side of the market, where we've seen most price compression, but it's starting to feed down into the smaller parts of the market too. And we think this progression in terms of market structure with originators looking more like capital market desks now and less like pure play direct lenders is going to come to the European market. And we're starting to see that happen in terms of fund creation. So the equivalent of the business development company in the US, particularly private BDCs, is the European LTAF 2.0, so the European Long-Term Investment Fund. And we've seen in 2024, we haven't got 2025's chart on here, but we've seen more and more launches from private fund managers, from fund managers such as Schroders as well, who have recognized this, that these are likely to be the growth vehicles and the vehicles that allow the wealth market to deploy capital efficiently into these investment opportunities. And these funds are evergreen funds with increasing amounts of liquidity provision for underlying investors. And this fits the thematic of public-private convergence, where you have less liquid assets in the same funds as more liquid assets, and you can balance portfolios in a way that allows them to meet the liquidity regulations of the LTIF regime. But more importantly, with private CLOs also coming to Europe as well. We had two last year, we've had one so far this year, and we expect to see more. We are again seeing more of a clubbed market in Europe, where multiple lenders can and are likely to be part of lending solutions for companies. And this is again starting to move the business model to one where we can now create diversified large portfolios of direct lending in Europe in the same way it's being created in the US, which again supports portfolio construction and the ability, as you say, to bring investors these interesting investment opportunities. And this takes a sort of step further in terms of how we see access in particular, and Schroders is set up in a way that is slightly unique, because we are already an investor as a limited partner in many of Europe's direct lending funds. And as part of that, we have access to deal flow as a co-investor. First right to refusal is what it's largely known as. We also have strong direct lending partnerships through time and history in terms of who we've been working with as individuals over a great number of years, over multiple decades, as well as deep banking relationships that allow us to source deals again from bank balance sheets in the same way as that private equity have been doing for many years too. So this route of origination is both diverse and has limited conflict of interest in terms of allowing us to look at multiple deal flow at any one moment of time, but not forced into any particular deal flow in terms of execution, other than those deals that we think fit what we want to do from a strategic perspective in terms of our asset allocation and single name credit selection, which is a bit different from the previous setup where you had large managers with large origination teams spread across different jurisdictions, and those origination teams ultimately pushing what they've originated back onto the underwriting desk and asking them to essentially make that lend based on their relationship. And that conflict is obviously then created. For us, that doesn't exist. But the important piece here is that we see all deal flow at any one moment in time within the market and make sure that we have access to that. And the great benefit of this is this wave of funds that is coming through in the market, because if you don't need large origination teams and the cost of large origination teams, your management fees can be a lot lower. So your cost to be invested in this type of fund structure is likely to be lower or a lot lower. So from our perspective, we think that we can nearly halve the management fee relative to a traditional direct lending fund in Europe. And you can see the average fees here going all the way back to 2005 for direct lending funds, and they are still some of the most expensive credit funds out there, which we think is largely an outdated business model relative to where the LTAF fund regime is likely to take fees on a look-forward basis. So how do you monetize this? Is the last section that we'll talk about. We talked about the fund structure being LTIF 2.0, which allows you to combine direct lending with syndicated loans with high yield bonds, such as an investor, you can now allocate to a manager who can look through all these three verticals without this issue of misallocation of capital, without the conflict of interest, construct and build portfolios around that, and use the different liquidity profiles of those three markets to capture the best risk-adjusted returns through market cycles. And there's information about those individual asset classes here that I won't touch on at this stage, but it's there for your reference. And that essentially gives you fund structures that, broadly speaking, in today's market, gives you 8% yields in Europe, 10% in US dollar, or 10% in sterling. A fund that has very little interest rate risk, so your floating rate allows you to capture any future rate rises, depending on your view on inflationary pressures globally. Rates stay as they are or do go up a little bit. You won't suffer from capital loss at that point. You'll actually receive more income in a rising rate environment. One of low volatility, with allocation around some direct lending opportunities, albeit ones where we think the risk-adjusted return is better. That gives you low volatility into the fund. The syndicated market in Europe is low volatility than the high-yield market as well, for example, but the ability to move across. And then what's interesting, again, is these fund structures are bringing for the first time daily NAV to the market in terms of look-through of pricing into private assets that sit within these fund structures that enable ultimately daily subscriptions and monthly redemptions as per, as I say, the rules of the LTIF regime. And that daily NAV we think is particularly pertinent because it's from a governance perspective, that's a huge improvement where you have third parties ultimately looking at private loans in this universe and agreeing or disagreeing on whether or not they are marked at the right price to allow investors, as I say, to potentially deploy capital on a daily basis, but also a fund structure that has no capital drag because as money comes into these fund structures, it can be deployed on a daily basis, either into the ongoing deal flow that is created on the private side, but also the secondary market within the syndicated loan space and the high yield bond space. Again, based on what is under the portfolio manager's view of the world, what is the most attractive risk-adjusted opportunity on that particular day, week, or month. And just to arithmetically make the case here, if we think about, well, surely, where is really the opportunity set to, move allocations around between these three verticals and really capture alpha and material upside, et cetera, what we've done here is we've actually mapped the spreads of all three markets going back 5 years. And you can see over the last 5-year period, there have been 3 periods within 5 years where public market capital appreciation has been there on the table to allow a manager to shift. This is from a top-down, let alone a bottom-up perspective, allow a manager to shift their allocation to capture those pricing dislocations in the market between public and private credit. And benefit in terms of alpha creation, bottom-up stock selection, and pass that on to investors across these funds. If you are just doing this in a fund of funds format or just thinking about moving allocation around from X to Y, this we think is quite tricky, both in terms of market timing, but you're not seeing individual deal flow or secondary market opportunities in real time below the waterline. And a manager who's looking across all 3 of these verticals at the particular moment in time will be able to capture these price inefficiencies. And as I say, deliver that in the form of alpha to you as an investor across this credit continuum of syndicated loans, direct lending, and high yield bonds. And you can see on the far right-hand side what I talked about in terms of this sort of price convergence between the 3 markets, really over the last year, where actually they are pricing, have priced nearly on top of each other at several points, but one where a generic allocation into direct lending we think just doesn't work from a look-forward perspective. And really, again, making the point around price dispersion outside of just the levels of index yields and returns that you think are on offer. We look at the whole market in terms of dispersion that's available, in terms of interesting investment ideas, not just in the primary market, but also in the secondary side too. And below the waterline of simple index yields, both in, say, syndicated loans or high yield market, there is always a plethora of dispersion there, of interesting opportunities for us to capture, and as I say, deliver better returns than ones you can experience through just general index or passive investing in this space. So I'm going to wrap up in a minute. Again, on this slide, what we've seen is, there are various questions that have been sort of thrown out. And again, I'm not going to go through them really because we've covered a lot of them, but certain sort of questions around, how and why does this work? Why should we think about merging essentially public and private credit allocations into one portfolio? What's the real upside of this, and some of the benefits of that fund structure? And we tackle some of those questions here, and there's some answers off the back of that too. So just to wrap up, we think this is one of the most interesting spaces within the credit markets right now, particularly in Europe. The partial emergence of public-private credit into one credit continuum to capture the inefficiencies that have been created by investors being siloed up until this point. And with the new creation of LTIF evergreen funds, with the ability to take a daily NAV print, provide investors with daily liquidity on the way in, monthly liquidity or bi-monthly on the way out, we think it is time for investors to start to reconsider how they deploy capital within the direct lending space and move to more flexible structures that allow them to capture alpha across the full credit cycle. Thank you for your time. We're very welcome to take further questions. I'm going to bring Mark back in at this point to officiate. And yeah, we're here for any comments that anyone may have.
Henry, thank you so much. That's greatly appreciated. Dear guests, this is the moment where you should be using the chat function if you have not done so yet. I've received by email 2 questions that are somewhat related. Well, one question really is, First Brands was sort of a wake-up call where people said, what's going on? How does it look like and how will it pan out? From your point of view and with your experience, what are the signs that we should look at? What are the red flags we should realize to avoid investments in a first brand type of situation?
Yeah. Firstly, I'd say, in my view of the first brand situation is symptomatic, not systematic. And symptomatic in the concept of that, what I really mean is it's around this creation of excess liquidity and capital chasing opportunities in the private markets, and people looking at returns and trying to capture those returns in a way that they think is interesting and potentially safer than doing it in perhaps the public markets. However, by looking at those opportunities, a number of investors have perhaps not focused on the day-to-day homework of understanding what they're investing in and what the underlying assets or situation are within that opportunity set. And so I've had conversations and interviews with investees directly on the off balance sheet side of First Brand, so the private side, to understand what they were shown in terms of information and how they got comfortable ultimately with potentially allocating capital to those types of deals. And the big red flags, and we've seen some of these in a couple of other places, is around disclosure. What are you investing in? Where is it? Can you go touch and feel it if it's an asset-backed solution? And the big red flags around First Brands were they were operating invoice financing loans, which they were essentially syndicating themselves, i.e. the company. There was no third-party financial advisor. There was no investment bank to provide governance to that solution. And when investors said, "Oh, that looks like an interesting deal. Can we come to the warehouse to actually look at the inventory that I have security over?" They were told that, "No, we don't do that. You can't come and look at the warehouse where, in theory, your security sits." So for me, situations like that where you are doing your due diligence and you are ticking off the boxes in order to make sure that the lending you're doing is safe and consistent with your strategy, i.e. asset backed. If you can't tick those boxes, you shouldn't simply be doing that type of lending. And we're also aware of there were fund structures offered to investors around asset-backed trade financing, right? There are funds out there in the world who claim to offer higher yields to investors based off this solution. And this isn't the sort of the first time we've seen trade financing go a little bit wrong. So Greensill Capital in the UK, for those who were paying attention a few years ago as well, again, a situation where they were lending in ways that became very not conservative and very not asset backed. And investors who were with Greensill were under the belief that what they're investing in was essentially asset backed. And should something go wrong with the underlying company, because they had security over the working capital of that business, that would ultimately get them all their money back. And that obviously proved not to be the case. And once again, history has repeated itself in First Brands in terms of investors who were in trade financing funds who had exposure to First Brands. The expected recovery for large parts of that is going to be zero, and not 100. And so if it's too good to be true, ask lots of questions around that situation. And if you don't get disclosure around what you're actually investing in, don't do it, is my advice.
Yeah. Okay, I think that's extremely appreciated by all of us. And then we had a question with regards to the actual debt market, right? We know that generally speaking, on a global scale, there's never been more debt, more borrowing than at this point in time in history of humanity. Now, when I looked at your slide, you looked at 2007 to 2024, and you compared, and basically bank lending has gone up, whereas the lending private debt has gone up. And it seems to me that, at least in Europe, it's sort of in balance. The trillion that we've lost from the banks is sort of made up in private or direct. Is that a correct statement? And how does it look on the US side, US dollar side?
Yeah, no, you're absolutely right, Mark. And actually, the number in Europe is we've seen net decline in overall lending to corporates, because up to 2007, corporates were more levered across the board than they are today. So we've actually seen deleveraging across corporate balance sheets, and we've seen deleveraging across the European consumers. And this really doesn't change depending on which jurisdiction in Europe you look at. However, where's that debt now live? And this is a more of the wider credit market assumption, is that we've seen huge growth in sovereign balance sheets, right? That's where large amounts of debt now sit on a global basis. And that's sort of similar in the US as well, where again, we've seen growth actually on both sides. So unlike Europe, where we've seen large swelling of sovereign balance sheets and a small decline in corporates and consumer, in the US, we've seen similar in the consumer side. We have seen, depending on the credit part of the credit market, you have seen relative stability around the investment grade side of the market. You move to the leverage part of the market, sub-investment grade, and we have seen growth again in terms of the syndicated market has grown over there. The private lending market has grown over there. So we have seen, in my view, some growth, as we say, in leverage on the corporate side in the States as well. And we're seeing obviously a new cycle here in the States in real time right now around AI spending and CapEx spending, where they are shifting from covering that with free cash flow to come into the investment grade and the high yield bond markets in particular, and some of the private credit markets, and they're raising large amounts of debt capital to finance this capex boom right now. At the same time as the fiscal situation in the States is they are undertaking again large amounts of borrowing, and the size of the US balance sheet is still growing too. So in essence, the US side is a double whammy. Everything really apart from the consumer is going up in leverage, whereas in Europe it's really limited to sovereign side of things. And even on the sovereign side, there's some dispersion there. So you've seen deleveraging in Ireland, deleveraging in Greece, deleveraging in Spain. Italy, for the first time in my lifetime, is sort of getting a grip of its fiscal situation. And actually, the sort of the spin round is that the UK, France, Germany are actually those that have more pressures on their balance sheets now from a sovereign perspective, which is very different to where we were 10 years ago. But yes, very interesting movement across the board.
Fantastic. Thank you so much. We have an additional question. Let me just pull that out. So if the credit markets below is up, it seems like bank. Do you see the chat, Henry?
I do, yeah. I'm just reading
Yeah.
it now. So I'll read out, yeah. So if the credit markets blow up, it seems like banks will be sheltered and PE firms and other private lenders will suffer this time. How can governments manage the blow up this time around different players? So I think you're right in the sense of I think banks are a lot more protected this time, that's for sure, because we've moved all of or a large amounts of the higher risk lending has come off balance sheets. On the US side, it was always originate to distribute model, but did it actually save them in 2008? No, it didn't, because they managed to find other ways to hurt themselves. And that's more around the regulatory picture. And the regulations have been put in place to try and improve that. But we know that the US is in a weakening regulatory regime, and one that may change again next year in terms of what banks can do in terms of risk appetite. In Europe, I totally agree. The regs in Europe are pretty tough for banks in terms of what they can do, the risks that they can take, particularly around some of the more exotic parts of the credit space. And so, yes, I think it's fair to say that banks will be better. And this was all about the linkage of stopping systemic breakdown of the credit markets from banks essentially being able to provide capital and the linkage back to consumer deposits, and having that, if you like, that Chinese wall fire break system in place, that if the leverage parts of the market become highly stressed, the losers in that clearly are your traditional investors, so the PE investors, your third-party fund investors, rather than, as I say, having strong blowback into the wider economy. And so, how can governments manage the blow up this time with different players? I think they're already doing some work around that. Everyone is now shining a light on the private credit space in particular, trying to find out who has exposure and in what way and which way. I think the overall size of the market, which we talked about, sort of 2 trillion globally, sounds like a large number, but relative to the size of other capital markets and other lending parts of the market, we don't think that's systemic in the same way as perhaps we were, as you say, 10, 15 years ago in terms of the way the banks were behaving. And whilst you always get spread blowback and some ructions around how this works its way through the market, we do think the actions that regulators, particularly in Europe, have taken and the US is sort of just about holding on, have will shield investors, and well, not investors per se, will shelter the financial system a little bit better than we saw in the past. So yes, it's definitely better. We are at a point in the credit markets though where we would like to see sort of more prudence coming in, and it's something we watched very closely. And you say there have been a couple of accidents recently. The implications of that haven't blown back into the markets or created any other major problems. And we think that's a reasonable test case in terms of what we think is likely to happen around the edges. And that is normal in terms of misallocation of capital, destruction of capital, mending of balance sheets, and then new credit cycles begin. So we'll see what happens this time, but it looks like certainly from a sort of corporate side, we are better protected than we were last time.
Fantastic. I think we are sort of running out of time, or over a little bit already, and I don't see immediate additional questions. So let me take the opportunity to thank you, Henry, for your presentation, for being with us, and for the insightful words. The audience for being part of the call, it's greatly appreciated. Then the team behind who makes these calls possible, both at Schroders and at our side, thank you very much for your work. And then, of course, dear audience, to all of you for being part of the call today. We would love to see you again, latest by December 16th, 9:30 in Europe, 4:30 in Asia. Probus Pleion Group, thank you very much. We're large enough to matter and small enough to care. Thank you all, and goodbye.